What an incredible day for the stock market with the S&P 500 up over 3%. Not only that, but that follows yesterday's massive rise to bring our grand total up to about 5.7% over 2 days. The last time that happened was in April of 2020. So this is not a normal 2-day move that we've just experienced. However, before we get too excited about this move, we have to remind ourselves that we were effectively just correcting an extremely oversold situation from a couple of weeks ago when we had 5 days in a row of oversold cluster signals. However, credit where credit is due, 99% of the stocks closed in the green today, and so it was a rare, joyous day for the bulls. In tonight's video, we'll take a look at all of that, see what it means for our posture perspective. We'll also get into some sector analysis and some interest rate analysis and some foreign stock analysis along with commodities and a whole lot of other excellent things. Make sure you check that out. And then, of course, we'll also do a trade application example on one of the world's most well-known consumer discretionary brands. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 4th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You'll also find at the bottom of the emails the stocks that are giving you overbought and oversold cluster signals within the S&P 500. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, got the heat map for the S&P 500. And my oh my, you'll rarely see a heat map this green. In fact, I just got done posting here on Twitter a moment ago that there were only 6 stocks in the S&P 500 that closed lower today. So that's basically a 99% green day with only 1% in the red. And that is incredibly rare. And of course, to top it all off, we had a fantastic start to the month of October and the fourth quarter in general yesterday. So to have back-to-back aggressive up moves like this has been certainly welcome for a lot of folks that have stocks in their long-term portfolios at a minimum. And so we'll see where it takes us, but this was an overwhelming victory here today for the bulls. The biggest mover in the S&P 500 is worth mentioning. That was Twitter. As you can see, it was up 22% here today as a result of Elon Musk apparently changing his position on his decision to buy Twitter. It sounds like he is now going to move forward with his original purchase price that he announced way back in the spring. A lot of folks were caught by surprise with that, thinking that he would eventually be able to work that deal price down quite considerably, considering the stock market itself is down considerably since he made the announcement. But apparently, Elon is kind of sick of going through the hoops and is just deciding to go forward with it, or at least that's what the impression is at this moment in time. So Twitter, not the biggest company in the S&P 500 by any means, but still a $40 billion stock that was up 22% in one single day. There were, of course, a lot of other double-digit movers out there. A number of them were kind of in the travel and leisure space. In particular, some of the casinos, like Caesars, was up in double digits percentages. We also had the cruise ship companies, Norwegian and Royal Caribbean and Carnival, all in the double-digit percentages to the plus side as well. However, keep in mind, many of those have been really decimated here in the last several weeks. Some of you may have heard, unfortunately, I caught COVID, even though I'm fully vaxxed and boosted and all that good stuff. But last time I was with you, I had mentioned that I had taken the test because I was already feeling sick that day. And it came back negative the first day. Well, wouldn't you know, I took it the very next day, and it came back positive. And just to be sure, I went to the doctor the day after that and tested positive again. So I've really been kind of struggling personally with COVID for whatever reason. I understand that most people who are getting it these days really aren't having as big of issues in terms of symptoms, at least compared to what I ended up receiving. So I guess I'm the lucky guy there, but it's been a struggle the last couple of weeks. So I appreciate your guys' flexibility around my class schedule and presentations and all that good stuff. But one of the things that I encountered when I was going through this whole rigmarole is I had asked the doctor if I could get Paxlovid, which is that medicine from Pfizer that is supposed to help with your symptoms after you get COVID. And my doctor told me that I was not eligible for it. My understanding is that pretty much anybody who is over the age of 65 would be eligible for it. So, word to the rest of you there in case you do come down with it and you're over 65, you get a pretty good chance, at least here in the United States, of being prescribed that. But if you're under 65, as I am, then you need to have some sort of a pre-medical condition, having a history of cancer or lung issues or diabetes or, being a lifelong smoker or something along those lines. And for better or for worse, I didn't qualify for any of the rest. So basically, the doctor said you just have to kind of gut it out with lots of rest and lots of fluids. And it was a struggle for me. But the other thing that the doctor told me was that in a year from right now, there's a lot of hope that this Paxlovid and some other similar medicines will be pretty much freely available to everybody, the entire population. They were a little bit caught off guard just simply because it's kind of, issued on an emergency status right now. And of course, we've only been dealing with this COVID thing for a couple of years. So, advancing the science and the medicine does take a bit of time there. But the doctor said that there was some optimism that within a year or so, there would be treatments available for pretty much everybody who came down with COVID. And if that is true, now, of course, this is just one conversation with one doctor, so I don't know this to be an absolute fact. But if it is true, I'd have to believe that traveling is going to be a lot more enticing to a larger subset of people if they don't fear that they're going to, get off the airplane having COVID from their next door neighbor who is sitting next to them on the airplane. And so I think that's kind of an interesting side conversation, especially knowing what I just went through. Of course, this is probably not pressing information for most of you because you haven't been dealing with it. But given the last week and a half that I've just gone through, which has been pretty miserable, quite frankly, I can see where the availability of medicines could open up a lot more travel and discretionary spending moving forward. So let's keep our eye on that possibility. But certainly today, the cruise ships and the casino stocks were just ripping higher. And Wynn, by the way, many of you have been to the Wynn Resort in Las Vegas. It was up nearly double-digit percentages today as well. But really, it's hard to argue with what we see in front of us. It was green, green, green across the screen. And very few red ones out there. Dollar General was an example of one that was down 0.5%. Sometimes those dollar stores benefit when the economy gets really weak, and then when we have a big risk-on day like we had today, it's kind of the opposite. Folks are willing to sell those and kind of move into the more aggressive and cyclical areas of the market. But, Microsoft, Apple, Amazon, Tesla, JP Morgan, Google, Visa, United Healthcare and the like, all the biggest squares all came through with big positive performances today, which allowed the S&P 500 itself to be up 3%. Let's go ahead and take a look at our specific statistics. Excuse me. I do have a lingering cough, I will warn you, so I hope not to let it get out of control, and I can always go back and edit these market outlook videos in case I do have a coughing spell. But if I'm coughing here or there in the coming weeks, I do understand that lingering cough is kind of a side effect of having COVID, and so it's just something I'm dealing with right now, so my apologies in advance. But anyway, here on the Visualize tab, you can see what I was referencing before, what a marvelous day it was for the stock market here in the United States. You rarely see, a one-sided market like this, especially, excuse me, on the green side of the equation. Remember, markets tend to be a bit more correlated on the downside. It seems like when the market's in an absolutely terrible mood, it doesn't care what stock you are, it is going to sell you off. On the upside, it seems to, be a little bit more picky and a little more choosy. But today that wasn't the case. 496 stocks of the S&P 500 closed in the green today, with only 6 in the red. So 99% of stocks in the S&P 500, which controls the vast majority of market cap here in the United States, closed positive today. You do not see that very often. And of course, some monstrous moves along the way, considering the S&P 500 itself was up 3%. Naturally, there's going to be a lot of stocks that were up, between 5 and 10% along the way, and important ones as well, not just afterthought types of companies. Big mega cap companies up considerably here today. Let's now take a look at some of our charts. And as is often the case, I like to look at this chart 6D when we have at least a 1% move in either the up or the down direction, to try to give us a sense of what the volatility has been like here recently. Now this chart looks a little bit different right now because I wanted to point out something to you guys that is pretty rare, and that is combining 2 days worth of performance together. Usually when we're looking at this, we're looking at just 1 day in terms of its aggregation period. But for those of you that have access to these charts, remember, all of you who are premium members of Market Scholars have access to the 50 plus customized charts that David and I use. Remember, if you're not a premium member of Market Scholars, there's a pretty good chance that we'll be throwing our annual Black Friday sale next month, as we pretty much do every year, where we'll be throwing our 3-year premium subscription on sale for 20% off. So keep that in the back of your mind as you move forward if you want to kind of up the ante on your education from the investing point of view. But anyway, if you are one of our current premium members, this is simply chart 6D. Now, normally when I pull this up, I'll show you what it kind of looks like typically when I pull it up. Hang on just a second. Here's the default view of it. And you can kind of see what I was referencing before. The green line stretched all the way up to this pink line, and that pink line says it was a 3% up move. So we went well beyond the blue line that I typically point out, which is a 1% move. We went well beyond the orange line, which we don't hit as often, but that's a 2% move. And then we went all the way up to this pink line, which is a 3% one-day move, which is pretty rare. Remember, this is a 1 year, 1 day look back chart that we're looking at here on the default mode. And really, we've only had, this is basically the third time that has happened in a year. It happened back here on May 4th. It happened right here on June 24th, and then it happened today. So that kind of puts things into perspective as to how rare a day like today is all by itself. Only 3 times in the last year has that happened. And then when you combine it with the fact that yesterday, you can see yesterday's green bar here rose from this black horizontal line all the way beyond this orange line. It didn't quite stretch to the pink line like today's did, but almost got there. Notice that that is incredibly rare. You rarely have back-to-back days that are that aggressively bullish. So one thing that you could do is you can come up here above the chart, change the time frame by clicking that D that you see up there, and then clicking on time frame right here in kind of that sub menu area. And then in this aggregation period down here where it says day by default, click on that and choose 2 days instead. So what it's going to do is it's going to combine the last 2 days and kind of show it as though it were one candle. And I'm going to change this from a 1 year chart to a 3 year chart. So we'll go back 3 years worth of time and we'll look at each 2 days combined together. When I hit OK, you can see how dramatic the last 2 days have been. Here's that green line, and I do apologize. I know it's a lot thinner now because we're looking at 3 years worth of data, so it's a little bit harder to see it there, especially if you're using a cell phone right here. But I will just tell you we're up there at basically 5.72%. So that is our 2-day return, 5.72%. Now remember, the stock market over the long haul has generally delivered 8 to 10% annualized returns. So each year you make somewhere between 8 and 10% on average. Obviously, every year is different, as we are so finding out here in 2022. But that should put things into perspective for you as well. Typically, the market only goes up 8 to 10% in an entire year. The last 2 days, we were up 5.7%. So not quite into that 8 to 10% range, but knocking on the door of it with just 2 trading days. And to show you how rare that is, I'm kind of pointing right at the top of that green bar right now, and you can kind of use my my mouse and the crosshairs that are provided by scanning your eyes to the left with that thin gray bar, and you can see that the only other time, or the last time I should say, that it happened was going all the way back to right here, that one right there. And that was way back in April of 2020. So that was more than 2 years ago. Have we seen a 2-day rally like we just witnessed right now? And of course, you saw we had a couple of other days like that during that time period as well, because that was during the incredibly chaotic period of the coronavirus, the original COVID wipeout, not the delayed one that I managed to avoid for 2.5 years of my life and then randomly catch it all this time later. But when the whole world was concerned about COVID back here, and when it was really causing strain on healthcare systems and nursing homes and the like, there was a lot of chaotic trading activity back then. So you had not only big up days, but you also had massive down days. So anyway, wanted to point that out because it is so rare. And we don't see these types of 2-day moves very often throughout history. Just once every couple of years or so. Now keep in mind context around that as well. The reason we got such a robust move is because we had such an epic meltdown in the market for the better part of the month of September. And that kind of holds true with what you've heard David and I say countless times over the years as well, which is your biggest up days tend to happen in terrible market conditions, because you get to a point where the markets are so aggressively oversold that it leads to what a lot of people reference as a dead cat bounce. That's not my terminology, by the way, but that is something that you will hear out there. And so anyway, you have, you have the sharpest rebounds that take place after the sharpest corrections prior to those rebounds. So it doesn't necessarily lead you to believe that you are in the strongest market with the strongest trends. What it is finally kind of correcting perhaps an overreaction of too much selling prior to the big move. The VIX did fall today, by the way. It's down at about 29 right now. But that has kind of been interesting to watch as well, with the VIX, kind of being above 30 here more times than not in recent weeks, whereas for much of this year that was not the case. But we still haven't had that big spike into the 40s on the VIX that a lot of people have been waiting for. So whether that will happen down the road or not is anybody's guess. My gut tells me it probably will. I hope I'm wrong about that, by the way. But, I remain hesitant in this market environment despite the last 2 days of rally. I'm thrilled, I'm tickled pink that we've had the rally, but I still remain skeptical as though, hey, that was it, right? There are going to be some people that will say that was the bottom, and now we're off and running to all-time highs. And I'm just not sure I believe that personally. Typically, bearish moves in the market last on average 18 months. And remember, the NASDAQ topped out in late November of last year. We haven't even passed the 1-year anniversary of the NASDAQ topping out, let alone the S&P 500 that hit its high in early January of this year. And so it seems to me that we've probably got to kind of earn our keep a bit more from a time perspective, and probably from a price perspective as well. While it has certainly been sharp and painful when the market has been down 20 to 25%, remember, a lot of bearish moves throughout history will push you down even further than that. 30 to 40% would probably be closer to an average there. So, don't shoot the messenger. I'm just the one that is, delivering, delivering the analysis of what I've seen historically. And again, I hope I'm wrong about that, but my gut tells me we've still got work to do. So with that being said, let's go back to our normal 4-grid view now and see what this means from a market forecast perspective. This is chart 4B, and you can see here that the background colors of all 4 of our charts remain in that dark pink shading. And what that references is the fact that the intermediate posture on the various indices in the United States are still considered to be strongly bearish, according to the intermediate line on the market forecast technical indicator. Now, it's not that that particular line has a perfect track record, and it could certainly be wrong this time as well. But in general, I think it's also helpful to just kind of take a 30,000-foot view and look at these charts for a second, recognize the beauty of what has been the last 2 days to the upside, but also recognizing the fact that we are still below falling 30-day moving averages on all 4 of these indices. And to be honest with you, we still have a big air pocket between where we're trading right now and the moving average itself. Typically, you would think that if you had a historic 2-day move like we've just had, where you only see it once every couple of years, you would assume that you would at a minimum be touching the moving average, if not being above it. That's how aggressive that type of a bounce should be typically. But that again speaks to my point that I was making before. What we've witnessed in the last 2 days is simply a bit of a correction from what was extreme oversold conditions. I wasn't on Twitter as much as I typically am when I was going through my COVID situation, because I was resting and napping a lot more and sleeping, quite frankly. I kind of felt like a teenager or a college kid again, as late as I was sleeping into the morning. 10 o'clock one day, I even slept past noon. So admittedly, I was a little bit out of the loop compared to normal. But I was on Twitter here every so often during that time, and one of the things I posted was talking about this 5 days in a row of the S&P 500 giving us oversold cluster signals on a daily candle chart. And that has only happened a couple of times in history, according to all the information that we have. Now, the market forecast was not around back in the 1930s, so I'm sure there were probably other periods way back where we saw that. But in the last couple of decades where we've had the information on the market forecast technical indicator, you would have to go back to late 2018, where we saw 6 days in a row of oversold cluster signals, which basically called the low in the market during that time period. Many of you will recall that was during that terrible Christmas period of 2018. But once the selling was done during that week, we erupted higher, starting with the very first week in January of 2019. And so this was an extremely oversold condition here. In fact, what we saw with that 5-day sell-off right there, in fact, it was actually 6 days of selling, but 5 of those days getting the oversold cluster signals, that was probably more rare and emphatic than what we just witnessed to the upside in the last 2 days. So this extreme move over the last 2 days is simply correcting this extreme move that we had over here, both of them historical in nature, where you don't see it very often. So if we just kind of look at things from the grand scheme of things here and recognize where we're at and kind of set the enthusiasm of the last couple of days aside, and we see that we are still way below the falling 30-day moving average, it suggests that the path of least resistance does continue to be to the downside. Now, keep in mind, we do have midterm elections coming up here in the United States within the next month or so. And we are also entering into a more positively strong seasonality period for the year as well. In fact, I just posted a bunch of sectors and industries on Twitter that tend to do well starting in the month of October and going forward for the next few months. So again, if you're not following me on Twitter, I would encourage you to do so. My handle is @BrandonVanZ, and you'll see probably about 10 different sectors and industries that tend to do quite well starting in October. But if you look at kind of the major market indices and look at when is the best 3-month period, that is usually identified starting in November. So November, December, January tend to be the best 3-month period for the stock market. October is a little bit of an oddball month. Usually September is bad, and we just recognize that, of course, this year. But that had been the case. September is usually the worst month, and once again fulfilled on that promise in 2022. October is a little bit more hit and miss. You can actually have some pretty good Octobers out there, but the problem is market participants also remember that some of the worst market crashes in history have occurred in the month of October. Namely 1987, of course, comes to mind with the 22% meltdown in a single day. These days, that should not be allowed to happen because of circuit breakers and everything else like that. But it is true that October has kind of a strange reputation where when you look at the actual evidence of the statistics, it generally does okay, but when it does poorly, it does extremely poorly, like crash-like scenario. So, it's kind of a hit and miss type of a month, whereas when you get into November, December, January, those months are much more often consistently bullish. So who knows, maybe the calendar can bail us out after such aggressive selling earlier this year. It's something that we will, of course, try to keep our eye on. And that's the beauty of staring at the charts all the time the way that we do, and doing these free videos on YouTube as often as we do, is that when more information comes in, we can then change our opinion based upon that new information. And so obviously if the market has it in its mind that it wants to start rallying furiously now, eventually we'll start seeing resistance levels broken, moving averages broken to the upside, et cetera, which will kind of prove to us technically that it deserves to be considered more bullish. But right now, I'm not sure I'm in that camp. Right now, I still look at these charts and say, yeah, we're still falling below a declining 30-day moving average. And after one of the biggest 2-day moves in years, we are still a far cry from even touching the underside of that moving average, which basically means we're just correcting what was already extreme selling before, but it doesn't necessarily have to mean that this is the start of a big new bullish trend moving forward. Now you'll notice here the S&P 500 was up 3.06%. As I mentioned before, this is only the third time in the last year that it's been up 3% in a single day. The Dow Jones wasn't too far behind. It was up 2.8% here today, closing at its highs. You can see that basically all 4 of our charts close either at or very near their daily high here today. So that's a good, robust sign there as well. Down below, we'll see the NASDAQ was up 3.34% today. And so that did beat the S&P 500. Remember, that's fairly typical. NASDAQ is considered more aggressive, filled with technology and disruptive, innovative types of companies. And then the Russell 2000, which is basically the small caps here in the United States, almost was up 4% today. It was up 3.91% when it was all said and done. But despite that epic move, we are still a long ways from even touching the moving average. So we'll see where it takes us. But I think the kind of takeaway for the time being is it's important for us to curb our enthusiasm, whether you're Larry David or not. But curbing our enthusiasm or tempering our enthusiasm right now seems to make sense to me, recognizing that, yes, this was an epic 2-day rally, but we were overdue for some sort of a bounce. And it was just correcting or righting some wrongs more than actually a trend-changing type of a situation. And if that changes in the future, we'll be happy to relay that information as well. But for right now, I think you still probably should do your best to tread cautiously in a market like this. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these Market Outlook videos. The last time I did the video, 110 of you clicked like for me there on Twitter. And as long as we're up and over 100 likes, I'm happy to do a full-length video the next time I do it that includes a trade application example and extra charting analysis. On the days when we're under 100 likes, then I'll just plan on doing a quick hitter 15-minute video with no trade application example. So that way it allows you guys to have a little bit of input in the direction that you want to take the video. And for the most part, you guys have have done very well with that challenge this year. There's only been maybe 2 or 3 times this entire year where you guys have not gotten up and over the triple digits. So keep that up. And remember, there's 4 different ways you can click like for me. You can either go directly to my Twitter feed, and you'll see the most recent market outlook video post pinned to the top of my Twitter feed. You can click it right here if you're watching the video on our Market Scholars website. That's why we embed this little Twitter widget below our video each time we do it. So you can just click that heart right there. Remember that you can also access the tweet in question if you're watching this directly on YouTube. If you go into the description area of this video that you're watching, you'll see a hyperlink that will take you to the tweet in question. And then you can also find on the emails that we send those of you on the distribution list, there's a little Twitter icon near the bottom that if you click it, it will take you to the tweet in question. So whatever of those 4 ways you choose to participate, they all end up in the same place, and we do appreciate your participation there. Remember, it takes a big effort, several hours out of our day to do these free videos for you, so we don't want to waste your time, and hopefully you don't want to waste ours either. And we do appreciate those of you that are helping get the word out about our organization out there. It means a lot to us. Also, while we're over here, let's talk about the sector selector. This was updated as of Friday. I always remind you of that, but it's particularly important that I remind you of it this time because the last 2 days, Monday and Tuesday, have been so dramatic in the market, it's entirely likely that some of these rankings have already changed in just 2 days. If it's a normal 2-day period, that doesn't happen, but this has been a dramatic 2-day period that we've just gone through, and therefore we will probably see more changes when I update this again this upcoming Friday. But for right now, be aware that energy was able to get back onto the top slot. Remember, they've been kind of hit and miss throughout this year. For the first half of the year, they were the most consistent area at the top of the sector selector, and then started slipping kind of mid-year, and that gave way to the utilities actually becoming more consistent than energy. But one of the big things that happened this week was the reversal of those two. Energy was down at number 7, rocketed all the way to number 1. Meanwhile, utilities was number 1 and collapsed all the way down to number 8. The real estate had already been down. Many of you have heard me mention the relationship of utilities and REITs in regards to interest rate sensitivity throughout time. And what was a little bit peculiar this year was that real estate was suffering the way that you would assume it would when interest rates kept on rising day after day, week after week, month after month. Remember, we've had one of the most dramatic rises in interest rates that we've ever witnessed this calendar year. So it was not surprising to see real estate struggle in that environment, as there's always that bond trade-off effect. And of course, we spent a lot of time talking about that very concept and topic in my Monday afternoon options for long-term investors class, for those of you that want to check out that recording if you're a premium member. But there's that bond trade-off effect that takes place. And typically when interest rates are falling, like they had been in recent decades, there's a bond trade-off effect that takes place where people who would have otherwise been investing in bonds choose instead to invest in REITs and utilities as bond replacements because their yields are superior. So when the opposite happens and interest rates start going up, usually what you find in that environment is folks will then start selling off REITs and utilities and go back into the bond market. And so that relationship held true for real estate, but it wasn't really holding true for utilities. For whatever reason, utilities continued to, do really well on a relative basis, probably because they are considered more defensive in this very difficult market that we've been going through. But they finally had their comeuppance this last week, and they finally gave up the ghost after residing in the top 4 rankings for the better part of the last 3, 4, 5 months. They finally are now in the bottom half of the rankings, basically joining real estate, probably where they deserve due to their interest rate sensitivity. Meanwhile, you do have healthcare and consumer staples that remain up there near the top of the ranking, and like utilities, they have defensive characteristics and do better on a relative basis when we're in a risk-off type of a market environment. But they don't have as much interest rate sensitivity as what you typically find out of utilities and REITs. So I wouldn't be surprised to see them kind of hold up a little bit better in this type of market environment, assuming interest rates stay reasonably high. Now, we've actually seen a pretty sharp correction in interest rate yields or treasury yields here in just the last 2 days. We'll talk about that here in just a little bit when we get to our 12 grids. But and so that could change at some point. But if it doesn't and interest rates do continue to march higher, then I would venture to guess that REITs and utilities will probably struggle in that type of market environment. Also wanted to point out some additional content that's available for free for some of you who are interested in dividend growth investing. Remember, if you come over here to our blog on our website, you can click on dividend growth investing after you hover over blog. And that area of our website is unlocked for everybody, right? A lot of areas of our website have kind of a paywall where you need to have a premium access username to get to it. But this is one of those areas that we offer for free if you're interested in dividend growth investing. So you can attend my dividend growth investing classes that I teach every Tuesday morning, like I did this morning when we talked about the technology sector. But you can access some of the information that we discuss during those classes. And yesterday, I posted the dividend growth investing increase announcements from the month of September. So we gathered up all the increases from last month, put them together in a table right here to help you understand which areas perhaps are more impressive and which areas perhaps disappointed. And I spent a fairly strong amount of time in my DGI class this morning talking about which of these September dividend increasers impressed me and did better than I assumed they would, and which ones underwhelmed what my prior expectations would have been. So again, if you're a premium member of Market Scholars, feel free to listen to my analysis during class. That recording has now been posted to our Trading Rooms calendar. Otherwise, if you're not a premium member, you're still welcome to check out the information on the blog post itself. And then this weekend, I posted a different blog post in the dividend growth investing category. Again, the categories you can kind of see off to the right-hand side here. So if you clicked on dividend growth investing right there, it would take you to some of this free stuff that's available. And this is the dividend stairstep sector statistics, where once per month, I will try to gauge whether the market at large is undervalued, overvalued, or kind of neutrally valued. And right now, of course, this is as of September 30th. So, and I posted it actually on September 30th as well. So I had no idea, of course, what was going to happen on October 3rd yesterday and October 4th today. So this was posted before the last 2 days. But what I had mentioned on Twitter when I posted it there as well is this was the most undervalued that I have seen the market since I've started collecting these statistics. And you can see here, if you kind of zoom in a little bit more on the graphic, that 43% of the stocks that I cover in the dividend stair-step charts, and there's about 700 companies total that I cover for that, basically companies that have grown their dividends for at least 5 years in a row or more. And of those 700 companies, 43% of them are now trading in the blue zone of the dividend stair-step chart, which effectively means that their current dividend yield is considered to be attractive compared to what their historical yield has been over the last decade. And that is not a normal number. Typically, when you look at this, think of your traditional bell curve distribution, where you would assume that about 25% of stocks would be considered undervalued. This orange area off to the right-hand side here would be what we would consider to be the overvalued area. So those are stocks trading in the orange zone of the dividend stair-step charts. And what you would typically find in a normal operating market environment where you don't have extreme selling or extreme buying is perhaps about 25% undervalued, 25% overvalued, and 50% in that white neutral zone. That is not what we are dealing with right now. Right now we have 4 out of every 10 stocks that are considered to be extremely oversold to the point where their dividend yield is highly attractive right here, right now, or at least it was as of September 30th. that has probably pulled back a little bit in recent days with the furious market rally. Naturally, when stock prices roar higher, dividend yields go down, and some of those stocks that would have been in the blue zone have fallen out. But it's probably not a major dramatic difference. It might have gone down from like 43% down to 40% or something like that. So the point being, this is still considered an attractive time to be looking to put new money to work in the dividend growth investing long-term world. For those of you that have extra capital aside, and of course that's what we aim to do every single week in my dividend growth investing classes here at Market Scholars. And if you're not a member, we would encourage you to become one if that is of interest to you. Today we covered technology stocks. Last week we covered real estate investment trusts. And by the way, that class last week was actually held on Thursday instead of the traditional Tuesday, just because I needed some more time to kind of rest my voice and stuff with COVID. So if you're looking for it on our calendar, just look at Thursday's date for the dividend growth investing class. Normally it's on Tuesdays though. So anyway, 43% of stocks out there are considered attractive and undervalued right now. And some of the areas that are the most attractive from a sector perspective are communications, financials, discretionary, and staples. We did some analysis on this in my Options for Long-Term Investors class on Monday afternoon. So if you're a premium member, I'd invite you to go back and listen to my analysis in that class just yesterday afternoon, where we talked about not just what are this month's percentage breakdowns, but how that compared to the previous month. And there were dramatic differences from the end of August to the end of September. And we saw a pretty big shakeup in terms of which sectors were considered the most attractive as well. So anyway, kind of interesting to see, especially the staples up there as high as they are. Usually you would expect the staples stock prices to hold up a bit better during a market meltdown. And if they're holding up better price-wise, then the dividend yield is not going to really attractive levels. But in this type of a market environment where they're gunning for everybody out there, even the venerable consumer staples, which are oftentimes perceived as the best area sector-wise for dividend growth investing. It's my highest allocation area in my own accounts. The staples are where you have, stocks like Walmart and Colgate and Coca-Cola and Pepsi and Clorox and Kimberly-Clark and Procter & Gamble. I could go on and on. Those are some of the highest caliber companies on planet Earth when it comes to dividend growth. And usually you don't see the babies being thrown out with the bathwater as much as we have seen here more recently. Usually the staples hold up a little bit better, but even this most recent sell-off that we've had have been gunning for the staples as well. So very interesting times that we live in. Feel free to check that out on our website as well. Again, this is some free information that's available to all of you who are even not part of our premium program. All right, let's get back on track with some more charting analysis now and do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as you can see here, we've got a mix of green and pink charts. And for once, it's not just the two bottom corners that are green. Remember, more times than not this year, it's felt like pretty much all the charts are red except for the US dollar and the 10-year treasury yield. But right now, those two are actually light pink. Now, before we take that concept too far, remember they're both trading above their rising moving averages right now as well. And so, don't count them out quite yet, I guess is the takeaway there. Yes, the postures have shifted because their intermediate lines have fallen out of the upper reversal zone. Remember, the upper reversal zone on the market forecast technical indicator is 80. So the 10-year treasury yield is at 73 and falling, and the US dollar is at 65 and falling. So both of those were in the upper reversal zone a week ago, but has seen enough selling in the past week, both of them, where they have now kind of shifted their posture to weakly bearish. But remember, that's still not considered strongly bearish. These other charts up here near the top still have that darker shade of pink. Those are what we would consider to be strongly bearish charts. These two are just giving you some hints that perhaps a strongly bearish posture is on the way, but it could easily revert back to a bullish posture as well. You're kind of in no man's land when you have those lighter shadings on the chart. So yes, there's been enough selling here in the last week to demand a posture change, but because we're still sitting atop those moving averages, don't be surprised at all if we get some sort of a bounce here sooner rather than later. The US dollar was down 1.37% today. 10-year treasury was down once again and settled in at 3.61%. And remember, just last week, we were basically knocking on the door of a 4% yield. We went up to 3.99% during the normal market session. In the pre-market, I think it did touch 4%. So that goes to show you how quickly we've dropped. That's 40 basis points in basically 1 week's worth of time. And that's very sharp in the treasury market. So to me, that's the reason this market, the stock market, has been able to have legs, is because finally there's been a sigh of relief in the interest rate market that had been marching higher day after day after day after day for weeks and months, and then finally topped out. So if we can get a continued pullback in interest rates, I think the stock market could get some legs underneath of it. But the problem is the stock markets remain trading below their falling 30-day moving averages, and the treasury yield and interest rate market remain above their rising 30-day moving averages. And so you would have to have more aggressive movements than what we've seen thus far before that relationship is likely to change. If it does, of course, we'll be the first to tell you about it here in these videos. But for right now, I would say, it's probably setting up for some sort of a bounce in those two areas, which is probably bad news for the market at large. In terms of what the green charts are in front of us, the commodities are green here all of a sudden. We actually talked about some of the metals commodities, palladium specifically, in my trend trading class yesterday, but even gold has had a nice little rally here over the past week or so. You can see it was up another 1.43% today, and we are now with a weekly bullish posture. That's what the light shade of green is telling us. And oil was up 3.5% today, and it also has a light green background telling us that we have a weekly bullish posture. Gold probably looks a little healthier because it has cleared up and through its moving average, whereas oil is now testing the underside of its falling 30-day moving average, and it was not able to breach it here earlier today, which sets up the possibility that it uses it as resistance and rolls over starting tomorrow. Obviously, anything can happen, but just, brace yourself for that possibility, because more times than not, over the last 3 months, when it's gotten to the moving average, it's usually rolled over. Gotten to the moving average, it's rolled over. Here it was able to get through the moving average for about a week or so, but eventually rolled over, went back to the moving average here again, rolled over. So here we are back to the moving average, and as you can see, more times than not historically, that has been a time to sell oil, not to buy it. But will this time be different? There's always that possibility. Of course, we heard news today that North Korea was firing off some nuclear types of missiles over Japan and really scaring parts of the world here today. We don't know what will break out with Russia-Ukraine next, but there's talk about nuclear weapons with that skirmish. And of course, anything that is discussing any sort of military strategy in the Middle East has the possibility of perking up crude oil as well. So we have to also acknowledge it's not only technical analysis that drives price. There are also news items that can affect it. But organically, from a technical analysis perspective, it does strike us that oil is probably going to struggle at around these levels, simply because that's exactly what it's done many times in a row in the last 3 months. You can also see here, and by the way, with both oil and gold up today, no surprise that that was in response to a falling U.S. dollar. Remember, all else being equal, when the U.S. dollar is weak, commodities have a better chance of being strong. And you also tend to find that foreign markets can be strong as well. And that was the case today with EFA, which tracks Europe, Japan, Australia, up 4% today, and even the emerging markets in the foreign world up 3.27%. Both of those outperformed the U.S. market, which already had a brilliant day of its own. But it just goes to prove that when you have a big wipeout day on the U.S. dollar, that can have a positive impact on other types of securities that are out there. So you can see all the bonds remain in that strongly bearish territory and trading below their falling 30-day moving averages right now. Let's go ahead and take a look now at the Sector 12 grid. And here, we've gotten a few charts back to green, which is at least some progress. Remember, in recent weeks, we've pretty much had a clean sweep of bearish charts from a sector perspective, but we were able to turn the green lights back on with energy and with healthcare. And remember what I showed you there a moment ago on the sector selector. Energy was number 1, healthcare was, I believe, number 2. And so I guess that shouldn't be a big surprise. But remember, I did the sector selector graphic Friday night before knowing that those two, along with the rest of the market, the last 2 days, were going to erupt higher. So it's kind of nice to see that the sector selector tool that's available to our premium members, in a way, was able to predict that these two areas specifically were the only two that would go up so much in the 2 following days after I posted that graphic to get above their moving averages. You can see that the energy moving average actually turned green, telling us that price is back above a rising 30-day moving average. Healthcare, we breached that moving average, but notice the color went from red to yellow. And in this case, what that means is price is now above a falling moving average, which is still good, right? It's better than all the rest. Notice that every other single sector out there still has a red moving average, telling us price is below falling moving average. So it does seem to be pretty clear to me that energy and healthcare are the market's leaders right now. We actually bought a healthcare company in my top-down trend trading class both last week and this week. There's been a lot of biotech stocks that have really started to make some strong moves. Some of you might have seen some positive news about Alzheimer's here last week. That caused some big movements in a couple of well-known stocks and other things that are kind of perking up there in the healthcare world as well. So keep your eye on those two areas if you are intentionally looking for relative strength. It's not to say that relative strength is the way and the only way to success in the market, but if that is what you are specifically looking for as a trader, then it seems like those are the two areas that offer some of the better opportunity sets that are out there as well. For the most part, of course, today was a brilliant day across all of these sectors. Every single one was up, but in terms of who the best performing sector was, it was energy, up 4.3% today. But not too far away from that was financials. Financials were up 3.7% today. And then even communications, technology, discretionary, industrials, materials, they were all up over 3%. So to have more than half of the sectors up more than 3% in a single day is truly a rarity. Today was a quite aggressively strong and bullish day. But again, just kind of unwinding some of the extreme sell-offs that we had before that. You know, you look at something like industrials as just one example. You had 1, 2, 3, 4, 5 days of clusters in a row during that same time when the S&P 500 was doing that. You probably had the exact same 5 days in a row right here with the financials. So with both industrials and financials up between 3 and 4% today, naturally we would want to give them, throw them a parade for such aggressive moves. But it is just a reminder that all they did was basically get back to the start of when they started producing those oversold cluster signals to begin with. So they just unwound the extremely oversold conditions that had already existed prior to that. All right, let's go ahead and do our trade application example now. Oh, and by the way, just to make it official, the worst performer today was Staples. They were still up nicely, 1.52%, but that was the least aggressively strong move that we saw amongst all of these winners today. But let's do our trade application example now. And for that, I'm just going to pull up chart 3A. and we're going to pull up a very popular company of Starbucks. Now, Starbucks is obviously a company that's known wide and far across the globe, or near and far, however you want to say that. But, it's had kind of a sketchier year in general, like a lot of stocks have. Remember, as part of the consumer discretionary space, usually these types of stocks do poorly when you start dividing the haves and the have-nots in the market. Typically, when you would get into a more difficult economy, the discretionary stocks do poorly on a relative basis, and the consumer staple stocks do well on a relative basis, with the basic concept being that, hey, you still got to, go buy food at the grocery store, but you don't need to go spend $5 or $6 on a latte every single morning if you lost your job, right? That sort of a thing. So, having said that, Starbucks has been interesting in the last month and a half, not because of that, but because of the opposite of that. And that's what makes it stand out. You would have expected that in this type of market environment, Starbucks would be struggling. But they're not. In fact, they're probably one of the stronger stocks that are out there. Notice I've got a 3-month, one-day chart pulled up here, and this dotted gold line down below represents the pathway of the S&P 500 over the last 3 months of this chart. And what that basically tells us is if you had an opportunity to put either $10,000 into Starbucks or $10,000 into the S&P 500 3 months ago, you would have been far better off putting your money into Starbucks. You're actually up 12% in Starbucks over the last 3 months, which has felt like a nightmare for most investors, right? There are people that are, losing gobs and gobs of money in the stock market here recently, but Starbucks is kind of like, batting that all away like it's got Teflon on, as though it doesn't even know that the market is in meltdown mode. It's doing very well in the last 3 months. So again, speaking to that idea of relative strength, Starbucks most certainly has it, at least here on a 3-month basis. Now you'll notice Starbucks is still down 23% year to date. So earlier this year it did very, very poorly. But more recently, when the rest of the market was doing terribly and you would expect a consumer discretionary stock like this to follow suit, it really didn't. You could get away with saying Starbucks has actually carved out a pathway of higher highs and higher lows here, right? Clearly, you can see this high up here at 93. The prior high was down here at 89, so the highs went up. But in addition to that, you had a low right here at about 81 in the beginning of September, and then you had a follow-up low at 83 here at the end of September. And so higher highs, higher lows, not a lot of companies can make that claim. The other thing I would mention about that is there's not a whole lot of companies out there trading above their 30-day moving averages right now. Starbucks is one of them. I know this because I go through charts every single weekend in preparation of my top-down trend trading class, and I'm telling you, it's bleak out there. There are not a lot of companies trading above their 30-day moving averages right now. Starbucks is amongst those select few. So whatever the reason, Starbucks is seeing some bullish activity, and that is worth paying attention to in this really bearish market that we find ourselves in. Remember, Starbucks has a huge amount of business in China, so perhaps China is kind of starting to thaw out a little bit more in terms of their lockdowns that they've had with COVID. Maybe the expectation is that the cafes will be open and be brimming with customers, and the profits will start rolling in for Starbucks at greater rates than they had been previously. I don't know. What I do know is that this chart is stronger than most of the other charts that are out there. You can see that today we were up about 3.38%, slightly outperforming the S&P 500, and in doing so are now back above the rising 30-day moving average, which is posted there in green. You can also see that it changed the background color from pink to blue, telling us that the near-term posture is now considered bullish. We also have the green line at 40 and rising, so that would be considered weakly bullish from an intermediate posture perspective there as well. So what I chose to do with today's trade application example, and remember the trade has already been done. It was done while the market was open and was posted to all of you who are premium members to our Telegram channel, so that way you can be alerted to it as fast as possible. What I did was I sold a bull put spread in the month of November. And I think the strikes that I used were 82.50 for my sold strike and 80 for my bought strike. And I think I got 60 cents in credit for selling that. And so my break even on that would basically be $81.90. $81.90 is approximately right there where I'm circling with my mouse. And you'll notice that in the last 2 months, it's only touched that level once, right at the tippy low of that long lower shadow candle back on September 6th of 2022. At the very low of that day, it breached 81.90, but it closed well above that by the time the day was done. So the last time Starbucks closed below 81.90, you would have to go all the way back here to this candle on July 26th. So basically what I've done is I've done a trade where as long as it doesn't do something that it's done since July 26th, in other words, it stays above $81.90 between now and the middle of November, then I should make money with this trade. And I got our approximate 30% return on risk like we typically do with these credit spreads. So that's what I had for you here. I appreciate you checking this out. Again, thank you for your flexibility around my COVID situation last week. Hopefully I'll be back to 100% here soon enough, but still fighting against that virus as we speak, but at least feeling good enough to do these videos once again. So thank you for your patience. And if you got value out of this video that I presented to you tonight, I have one simple request for you. That is simply to click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do this video again on Thursday, I'll plan on doing another full-length video. If you would prefer the shorter 15-minute videos without a trade application example, then don't click like, and we can certainly go that route as well. So we'll let you guys decide on that. At any rate, I appreciate you guys tuning in here this evening, and I'll wish you all the best of success with your trades and your investments. Goodbye for now.